Also how to become a very responsible investor, and also talk about the behavioral blueprint that goes behind investing. So let's start by understanding, sir, what is the difference between an investor and a trader?
And I meet all these NRIs, and every single NRI that I have met has a large real estate portfolio. And they have bought flats in places like Hinjewadi and Hyderabad and Gurgaon and so many other places. And most of the investments were done without even visiting the site. Friend of yours is talking about or bragging about his successes in stock market, and you figure out that he has bought the latest EV stock which got listed, and you also go ahead and buy, thinking that he's a smart guy. Again, a speculative investment. There is no science behind this. There's no rationale beyond your friend in having invested in it. When you're holding that investment for a long period of time, it comes with certain uncertainties. And therefore, I buy a power stock in my portfolio. Why is he making that investment? Is he making that investment at the right price or not? What kind of targeted return does he have? Has he looked at all the risks of investing, in that particular investment?
That sounds like a lot of work, right? So doing this 360-degree analysis, due diligence, considering risk, understanding how volatility will impact.
Want to act on your own, then you will have to do these things if you have to protect your wealth and also grow your wealth.
Hello and welcome to another episode of Beyond Just Returns, where we talk about not just how to generate returns on your investments, but also how to become a very responsible investor. I have with me Mr. Raghvendra Nath, the MD of Ladderup Asset Management, and today we will talk about investing beyond charts, numbers, and data, and also talk about the behavioral blueprint that goes behind investing. Welcome, sir.
Yeah, thank you, Upasana. Glad to be here.
So let's start by understanding, sir, what is the difference between an investor and a trader?
That's a good question, Upasana. In fact, whoever I meet in my profession, everybody thinks that they are investing. They don't realize that probably 60-70% of their actions were actually trading. I'll give you an example. And in fact, I have a lot of clients. We have a small office in Dubai, and I go there regularly. And I meet all these NRIs, and every single NRI that I have met has a large real estate portfolio. And they have bought flats in places like Hinjewadi and Hyderabad and Gurgaon and so many other places. And most of the investments were done without even visiting the site. They saw an ad, their friend was buying a property, and therefore he had a phone call with them, and they also decided to. Now, when you have taken that action, you invested 50, 60 lakh, maybe a crore or 2 crores into a flat, and thinking that that property will appreciate in future, your due diligence was so minimal that there's just a broad thesis that this area will come up and the property price will go up and I will make money. So come to think of it, it's a speculative investment. There's no underlying thought process, research, or investigation behind that investment. And that is what I am referring to, that when you take decisions like these, you are having, maybe a get together at home, and there is this rich friend of yours. He's talking about or bragging about his successes in stock market. And you figure out that he has bought the latest EV stock which got listed, and you also go ahead and buy, thinking that he's a smart guy. That's why he has made all that money. Now, that investment that you are making is, again, a speculative investment. There is no science behind this. There's no rationale beyond your friend in having invested in it. Maybe your friend also did the same. So that is so. A lot of, whenever you are doing these investments which are short term in nature, where the only goal in mind is price appreciation and nothing else, and where you have not done enough, or you do not have enough understanding of the risks associated with that investment, or you think that those risks are too little to be given heed to, you are trading. So a lot of us are basically trading without even knowing that we are traders.
So, how would you define a real investor, a true investor?
See, when you're investing, okay, you have kind of you're determined to hold a instrument for a long period of time. Okay, when you're holding that investment for a long period of time, it comes with certain uncertainties, because whatever you thought is going to happen during this period may actually not happen. Okay, so let's say I'm investing in a stock saying that India has a bright future. Okay, and therefore I'm buying a stock based on that. Okay, that let's say power sector in India is very high growth, and therefore I buy a power stock in my portfolio. Now that assumption that I'm making is a very broad assumption. Okay, it may or may not come true, and even if it were to come true, it may happen in so many different ways. Maybe the power sector goes up, but this company doesn't do well. So an investor will look at all aspects of an investment, the positive things, the negative things, what can go wrong, what can go right. Why is he making that investment? Is he making that investment at the right price or not? What kind of targeted return does he have? Has he looked at all the risks of investing, in that particular investment? What are the alternatives that he has? So once you have considered all that, then you are basically having an investor's behavior. An investor is a person who's patient, who's investing with his eyes open, who doesn't get afraid of risks, volatility. But he's aware of the risks that he's undertaking, but he thinks that he can manage those risks. So let's say if I were to ask you, if you had 1 crore of rupees, and you want to invest that money and or maximize your return by investing in equities, and I say, are you okay with this 1 crore becoming 80 lakhs in the next 6 months? And if you are not,
Yeah.
then probably you have not matured as an investor. An investor will look at that. There could be a black swan, like we just are coming past a black swan. It's we should thank our political leadership that a ceasefire was announced, but it was a black swan. True. And we were in a situation which could have worsened any time. So that could have led to substantial losses. So when you have already planned for the downside, when the downside when happens, you don't panic, you don't act in haste. So investor behavior is basically something where you have done a maybe, for want of a better word, a 360-degree analysis of every investment that you undertake.
Interesting. So that sounds like a lot of work, right? So doing this 360-degree analysis, due diligence, considering risk, understanding how volatility will impact your portfolio, it's a lot of work. Is there a way that I could become an investor without doing all this on my own?
You can, why not? But there's no escaping. Escaping hard work, okay? And because if you want to act on your own, then you will have to do these things. If you have to protect your wealth and also grow your wealth, okay? If you cannot do that, if you think it's hard, it's boring, and others people have done it without it, maybe they were lucky. But if you want, then so if you do not have those skills, or you don't have a desire, then you go to professionals. There are enough professionals in India today, managing mutual funds, portfolio managers, wealth managers, who are all doing, this as a full-time vocation. And so whatever investments they'll propose, you can at least assume that if he's a good manager, of course, the manager has to be good. But if he's a good manager, he will all look at all the things when he's basically proposing something. And more importantly, actually, the investment journey is not the no. It does not stop at when you have invested. Most of us basically keep buying things, keep accumulating things, but we never go and check what has happened to them. So the monitoring of these investments become equally important. And in fact, that's the painful job. If you were enthusiastic, you may actually do all this analysis, whatever I talked about initially. But if I were to tell you that, okay, you need to do this every quarter, every 6 months, every 2 years, how enthused are you to do that kind of hard work? So if you are not able to monitor those investments, then even if you were investor, those investments may not give you desired results.
Interesting. You did mention earlier that, my friend bought this stock, so I went ahead and did it. Power, I thought, was going to do good as a sector, so I went and did it. Is it also what you call as herd mentality, that everybody else is doing, so I'm a part of the herd? And how dangerous is it?
In fact, it's very dangerous, actually. And with all this social media and apps, and everybody says you can say becoming a crorepati in 5 minutes, you will find 5 videos in that, on YouTube. It is becoming indeed, very dangerous, where everybody is trying to throw a short-term effective solution at you. And a herd mentality actually works like that. When the trend starts, everybody doubts the trend. The smart investors make money from that trend, and then seeing that more people join, and then more and more. And so by the time you enter the herd, that trend that you were thinking of, and which is being tom now, is already in its maturity, or it's actually become so expensive that even if there was a trend, doesn't make sense in buying that trend. And so herd mentality can actually either will result in suboptimal returns. Okay, so you can make money, but you make little money, or it can result in shocks that you invested and then it goes wrong. It goes down. In fact, if you were to look at every time, if you look at the markets behavior and equity markets, these things are very much visible because they are transparent. They are publicly available data. That the highest volumes in equity markets happen when the markets are there top. Why? Because everybody thinks that they can make money. And why do they think they can make money? Because in the previous 3 months, previous 6 months, previous 1 or 2 years, they have made that kind of money by just buying something on a whim, and that actually turning out to be a multi-bagger, and they're making 30-40%. And so they think they have skills, but it was just the market. And so most of the people join the herd much later in the cycles, and only the smarter people, only thoughtful investors basically create that trend or join the trend early on. In fact, if you were to look at most funds, IPO, NFOs come when the markets are at their peak.
True.
Nowadays nobody is launching new schemes because they know nobody is going to invest. You find the most gullible investors in a period when the markets are at the top. Every single fund house is launching schemes for no rhyme or reason. They have enough number of funds of all category, but they will invent something, they'll call business cycle fund, they'll call some special situation just to collect money. Because they know that investors have their guards down when the markets are roaring. You look at IPO market. Today there's no IPOs. No big IPOs are getting announced, in the last 4-5 months. I was looking at subscription data. 6 months back, on an average, an SME IPO was getting 100 times oversubscribed. So if somebody is wanting 10 crore from SME, it's a small company, 1,000 crore was being given to that company. मेरा ले लो, मेरा ले लो, मेरा ले लो, you know. अभी वो 10 करोड़ का IPO आता है तो उसको 10 ही करोड़ मिल रहा है, वो भी बड़ी मुश्किल से.
Correct.
You know, so it is so trend. So that's when the herd behavior is at its best, or you know, or most visible.
So if it so we were talking about equity markets specifically earlier. When you move to mutual funds, you hear a lot of news about best performing fund, 5-star rating. I think every fund more or less gets a 5-star rating at one point of time in the news or in the media. What kind of bias is that, and how dangerous is it to just go with the best performing all the time?
So you know, so that's what people in behavioral finance talk about, that recency bias. You know, you have made money in something, and you think that it will continue to make money. You know? And so based on your recent experiences, you start investing. You know, so that plays out very, very much in almost everything. When you go and look at real estate, you know, look at gold. Everybody wants to buy gold now at $3,200. Nobody was buying gold at $1,200. You know, when or in Indian rupees, where it was trading at 35,000-40,000 rupees. Now it's at 92,000. Everybody thinks that gold will now go to 1 lakh or 2 lakh or whatever. So it is that bias that, you know, gold has done well, so it will continue to do well. You know, funds are, and that's what in mutual funds also, because every single app, every single newspaper, every single channel, when they are discussing funds, they are saying top performers in last 3 years, last 1 year or last 2 years, as if this top performer is going to remain top performer in the next 3 years also, you know. So it's like expecting, abhi, you know, IPL mein this boy has come, what's his name? Vaibhav Raghuvanshi. He scored the fastest century in the history of IPL. And now everybody is expecting that he'll hit a century every time. Poor boy, you know, got out for whatever 2 runs in the next match. But that's the reality. You know, that doesn't make him a bad cricketer or whatever. If you basically betted on him thinking that he's going to score another century, then it's our mistake, not their boy's mistake. And similarly, funds basically keep on going up and down. You know, if a fund has gone up, it doesn't mean that it's going to remain up forever. If it was so easy, then everybody will be rich. No, you can just look at what is the past trend and then follow that trend. No brainer. You know, so it's not so easy. And in fact, the chances are you may go more wrong by investing in places which have made money, and then you think you will also make money.
Fair. So since we were talking about this trader versus investor, is trading always wrong, or what does a real trading world mean, and what impact could it have?
So trading is not wrong. I'm not saying that trading is bad. I know so many people who are extremely smart traders and who have made tons of money. In fact, come to think of it, trading is harder than investing. You know, you look at hedge fund managers. Most of them are basically trading on small trends. You know, they will basically get in and out of position for 1%, 0.5%, 1.5%. You know, and because they are kind of monitoring trends, they have to constantly keep looking at their screens. They can't take eyes off the screens. So it's a much harder job. Investor's job is much easier. You know, he just does the analysis and everything, looks at the upside, downside, invests, and then because he has invested for 10 years, he can't expect any results in next 1 month or 3 months or 6 months. So he becomes more patient. You know, he has to only monitor his investments to figure out whether you know, the trends are intact. Whatever his investment thesis is still true or not. You know, traders have to keep looking at opportunity every day. You know, so it's a much harder thing. You would keep hearing rocket scientists joining investment management firms. Why? Because they are mathematical geniuses. They can spot trends where an ordinary investor will not, or an ordinary trader will not. You know, so, and that's their edge, because In the world of trading, it is about your edge. Were you able to spot the trend early on? Were you disciplined enough to basically take money off the table when the trend was done? Did you have the downside protection if the trend were to go wrong? If you did, you are a smart trader and you can actually make as much money as an investor probably. But you need to understand that there are so many people who are reading these charts and going around and trading, and they may be making money. I have never traded. I don't know many traders, so I have no experience. But I find their jobs to be much more taxing than mine.
So let's talk about the risks involved now. Because of these behavioral biases, there are some risks involved when any investor is taking a decision. What type of risks do they need to keep in mind, and what is it that they need to do to avoid getting into trouble with investing?
So, risks are inherent to anything that we do in life, and the first risk that you have is whatever you thought did not happen. And so you thought you will make money and you did not make enough money. And the second part, which is more realistic and where what we call as risk, is that you thought you will make money and you end up losing money. So, but risk management is a very, very large subject. We can keep talking about days around it. I would only if I were to just kind of give you a little insights, the whole idea of being an investor is to look at risks carefully. What kind of investment horizon do you have? What can happen if I have a short investment horizon? What can go wrong in my investment thesis? That's all part of risk management. And if you have done a good risk management, when those risks appear on the horizon, you are not wavered. You stay the course. So if like I was asking you, if that 1 crore became 80 lakhs, it can happen. There are so many ways, that there's so many things which can now happen after all this trade talk is resolved, after India-Pak tension is resolved. There can be a new demon on the horizon which we have not even seen or heard, and which can create volatility in the market. So you need to be prepared. And there's this in world of investing, we call about this ostrich approach. कि आपने सर जमीन में डाल दिया, and then you are saying that world is a very safe place. So that's a bad idea, and that's what end up those ad hoc investors, which are actually traders, end up doing. Without understanding the consequences, they end up buying things with very, very flimsy investment thesis. That is basically completely ignoring the risk and then paying the huge amount of attention when the risks actually materialize. So you are buying at the wrong time and then you are selling at the wrong time. Good investors are aware of the risks. They are investing with their eyes open. And so you will, when those uncertainties hit you, you're already well prepared. You have diversified enough. You have invested in the highest quality places. There's so many ways you can manage risks. Which of course you will also be subjected to volatility when the risk arises. But when the risk goes away, when the normalcy return, and normalcy always returns. Because anything that is happening it's like हर रात के बाद सुबह होने वाली है. In life also we keep having these downturns and setbacks, but then when you go past that, you feel that it was a small bump. And that's the case in investing also. So once you have that understanding that okay, it's just a bump, and I had already figured out about this bump, I had planned for it. So then you are able to have a much better investment journey.
Got it. And we also see a lot of emotional connect to certain investments, especially in terms of stocks. As we were talking, people invest a lot of emotion into choosing the right stock in the portfolio. Is that a bad thing always, or is there some logic to it in the long run?
So the thing is that so what kind of emotion are you carrying is important, you know. In fact, just to give you the other side of it, we have been in this business for now almost 14-15 years, and almost every day my team will be analyzing some equity portfolio or other. The best investments that the guy had were the longest held, you know. So I've seen people who bought, you know, in fact, I recently met an investor. He has kept an old diary, some 1980 में खरीदी थी वो, किसी ने उसको gift की होगी, where he has put the date of investment and the number of shares that he bought. Okay. And I was seeing his diary. He invested 10,000 rupees, which has become 50 lakhs today. He invested 20,000, which has become 1 crore today. And he has pages and pages of it, you know. Now, if he was not emotional about these investments, if he was unemotional, he would have sold them a long ago, you know. So emotion is not bad. Okay, sticking to your investment bets and all that is not a bad thing at all. Okay, the thing is that you know, many times, though, when you get emotionally attached to wrong things, you become stubborn, you or whatever other things happen. That's something that you should avoid, you know. And so many times emotions can have positive effect, like the way what I told you, that story, or negative. You know, you ended up investing in a stock, you bought it for $100. It was a small company where some speculation was going on, and your friend suggested, you ended up buying, and then 100 becomes 90. You wait for it to become 100, then it becomes 85. Then you wait for 90, then it becomes 80. Then you wait, you know, and it goes on, and it becomes a penny stock, and you're stuck with that investment. You know, there's a friend of mine. I of course can't take his name. He had some ESOPs from a very large private sector bank, you know, and crores worth of it, you know. And he was emotional about it. I kept telling him that, you know, you are a single company risk, and you are not even working in that company. So why don't you start diversifying? I said कि तेरे पास करोड़ों रुपए के ये पड़े हुए हैं shares, तू 5 लाख रुपए की SIP कर दे, हर महीने 5 लाख के shares बेच और 5 लाख की SIP कर ले म्यूचुअल फंड में. वो शेयर ऊपर जाएगा तो मार्केट भी तो ऊपर जाएगी ना. He didn't listen. Okay, and then something happened in that bank, and you know, it fell down sharply, and his lifetime of wealth was reduced to lakhs. You know, by and substantial loss. So people get emotional about these things. You know, so that is the unemotional. That's where good investors score over kind of untrained investors. I won't call them bad investors. They are just untrained. They are not able to basically remove their biases or their emotions from the investments.
Fair. You've been dealing with thousands of investors, and in lakhs you might have interacted with people. What, according to you, currently should be a mindset shift in terms of investors? What do you think are the most or the biggest deterrents to the investment behavior? And what should be the minute or the larger changes in the mindset to become a better investor?
Yes. So, one thing is that in today's world, there is the number of options have become just humongous. I think there are thousands of mutual fund schemes. There are hundreds of ULIPs and insurance, thousands of realtors who are basically trying to sell you their properties. Hundreds of companies are accessing capital markets. So thousands of stocks to choose from. The amount of investment choices are so many that it's very easy to get confused. And from an investor's perspective, it's not humanly possible to actually have a very objective analysis of all available options and compare them properly and look at their risks and all that, and then decide a course, So unless you are very, very serious about doing things on your own and you can devote enough time to it, it is better to take help. And fortunately, because the world is becoming so competitive, most of this help is available at a very, very reasonable price. And लोग ये आजकल ये म्यूचुअल फंड सही है कैंपेन चल रहा है, वो लोग बोलते हैं डायरेक्ट प्लान, रेगुलर प्लान, and the difference is 1%, and then somebody will say 20 years में that difference become 30%. But people don't realize कि वो 1% is of, if you are giving 1% to somebody and he can help you maybe reduce your downside or increase the upside by 2%, then that 1% is justified, and by to save my 1%, I cannot put my 100% at risk, isn't it?
True.
And people don't have, I think there's just too much talk around this cost, So don't worry about cost, good things will always come at a cost. If you want to have a fantastic meal, you will have to pay for it, if you want to, so anything that you want to do in life, you have to, the better it is, the more cost you have to pay. That's natural, and that's in the world of investments also, So don't be your own, if you don't have expertise, rely on others. Too often that I see that, doctor के पास सब लोग बड़ी जल्दी से पहुंच जाते हैं, आर्किटेक्ट के पास बड़ी जल्दी से पहुंच जाते हैं और लाखों रुपया खर्च भी करते हैं. But when it comes to investments, which is the most important aspect of anybody's life, they become they become fund managers, and it is not right. So that is a mindset change that people need to undertake, because with the kind of options and the kind of volatility that people are witnessing, if you do not have advisor along with you, it's very, very easy to go wrong, So whether you are a trader or an investor, I think you should look at taking professional advice when you are making an investment, Of course, these biases that we discussed, herd mentality, and this it's natural. Anybody who's trying to do on his own, some amount of biases will always be there. So you can't. If I say that please don't do it, that's very easily said than done. It's like saying झूठ मत बोलो, पर on day to day में छोटे सब लोग बोलते रहते हैं. So it's so the biases will always be there, when you are investing, and the best fund managers also have biases. So I don't think we should get scared of it. But remaining disciplined, looking at investment choices, and then so whenever you are investing, if you are having a considered proper analysis before you are saying a yes or a no, I think if you are doing, you will be in a good place.
Perfect. I think it was very interesting to understand the behavioral side of investing along with all the number related talks that we do usually. So thank you so much for sharing these interesting insights with us. I hope this helps the audience become more informed and more aware in terms of their investing decisions.
I also hope so. Thank you so much.
Thank you.